Tax season is here and young professionals need to know how to maximise their returns in 2025. From deductions to salary packaging and government incentives, we're going to cover everything you need to know to keep more of your hard-earned cash. Joining me now is Dr Steve Enticott from CIA Tax in the studio to share more. What are the latest tax deductions you foresee young professionals needing to look into?
Well, tax season, Mike. Well, tax season around the world comes at different times, and Ticker being a global network, the principles are the same though. That's what I want to talk about. The tax principles across the world are very, very similar. You need income and you need deductions against that income. So what are the latest deductions that are available?
Hit me.
They're still the same. You know, if you can find a way, any shape or form, to have an expense item connected to your work income or your investment income or whatever income it might be, then it's something that should be at least considered as a deduction. One I stumbled across yesterday at my wife's graduation, she was questioning, should I be buying the pack or not, the photo pack, because they're actually quite expensive.
Yes, they are. Yes, they are.
About $300 to buy the photos. And we didn't really want them because, you know, we'd taken plenty of photos. But she was thinking about her post on LinkedIn and having a professional photo. So I could argue in her case that the only reason we bought the photo pack was to have a LinkedIn post to increase her career prospects or whatever it might be into the future. So yes, in that case, there's an argument to say the costs of getting your graduation photos done, if you're working at the time, is deductible, or at least partly deductible.
I think that's a really good example and something that a lot of people would overlook.
Yeah, and that's the second key point I wanted to make is, you know, even if you have an expense where you think it may or may not cross over, then you are allowed to apportion it. So for example, if you travel somewhere and I'm going to a conference, but I was going to go there anyway, and I want to have a 2-week holiday while I'm there.
Nice.
Well, yes, some of that trip, maybe some of those flights, but certainly the accommodation around that conference and your meals and everything else are claimable. So even if you can't find a reason to say, I can claim this, but if you can find a reason to say, well, I can partly claim it, then you can partly apportion the expense. So I reckon they're the two big ones. You know, don't do anything for tax reasons ever, because I might as well give you a bill for $10,000 today, Mike, and the best you'll get back is on the $5,000 as tax refund. It's silly. You never do anything for tax reasons.
Yeah.
But if you are doing things and there is a connection to what you're doing at work, no matter, you know, how small, minor, whatever it may be, then yes, there is an apportionment to claim.
But just on that, what are the common mistakes that you see people make all the time? Is it generally they overdo it?
Yeah, well, I reckon the biggest mistake nowadays is, overdo it. You may have got away with that historically, but now there's that many AI, algorithms, whatever, that's run over the tax data even before a human eye sees it. It's moving outside those parameters. So if you start to put down some claims and it doesn't fit with your industry code, you better make sure you've got some, you know, backup for those claims. So I think the biggest mistake people are making are stepping out of the norm. And if you step out of that norm, then you better make sure you're going to back it up, because you will get a letter from the tax authority saying, hey, your claims are a lot higher than everybody else in this industry. Tell us why. So I reckon that's
taking advantage.
Mistake. Yeah, exactly. If you're going to step out of the paradigm, then absolutely make sure you're covered, because you will be asked.
So historically speaking, what do you recommend when it comes to professionals lodging their own tax return or getting a professional like yourself to jump in?
Well, as an accountant, mate, I'm always going to say, right? Come and pay me. At the end of the day. No, look, I think it's a very valid point. Tax law around the world nowadays is not easy, and they're making it harder and harder, and it's more complex. There's nothing simple about tax. If your affairs are simple, you go to work, you don't have any work expenses, then what do you need an accountant for? You don't have any investments, you don't have any capital gains, you don't have any dividends, whatever it might be. Most of the tax work nowadays is done online through, in Australia, MyGov, other countries have their own systems as well, where you can pretty much just click and get your refund. So if your affairs are simple, very simple, I'd argue do it yourself.
Right.
You don't need to pay me.
But if you're looking at those side hustles.
Right. Yeah, exactly. That's where an accountant will, side hustles, investment, whatever it might be, a lot of work claims, travel, uni costs, whatever it might be, then I really do feel you do need to be speaking to an accountant. And I think in the main, you know, an accountant's cost is generally tax deductible anyway, so you're going to get a fair portion of it back. But they will always find a better, safer outcome for you anyway.
No, I think that's a really good point. So let's talk salary packaging and super contributions. How's that helping reduce tax?
Yeah, it's the super retirement funds. funds, whatever it might be in whatever country we're in at the moment. Ultimately, in Australia, if you put money into superannuation, it's taxed at 15 cents in the dollar. If you don't put it in, it'll be taxed at your marginal rate, and that could be anywhere between 0 and 50 cents in the dollar. That's something we need to be a little bit wary of. Some people put money into super, and the actual tax rate they're paying is actually lower than what they're putting it into. So you've got to also consider, should I be putting money into super as well? So, doing some numbers around that. Salary package is a good idea. If you wait till you receive your money and then you put your money in after tax into super, you'll generally get the same claim anyway. If you put it in a salary packaging, a greater amount is going in and earning income off itself, rather than having to wait later for that tax refund effect to make that difference. Salary packaging's great. Yeah, everyone should consider it. In Australia, EV cars are the go. My wife bought an EV car.
Oh, yeah?
Yes, and it's free. So it's effectively free. So a $30,000 EV car is effectively free if you're doing salary packaging, because right up until 2030, your lease costs or your purchase costs, whatever it might be, are tax deductible. And then you've got all your fuel savings, $2-3 grand a year, $5 grand a year, whatever it might be. Your rego, your insurance, everything else is tax deductible. So when you put all the tax savings in, my wife is actually getting paid to drive a free EV car. So it depends where you are around the world. But in Australia, low value EV cars that you can salary packaging,
boom,
you might as well have a free car.
There we go. Dr. Steve Enticott, thank you for joining us on the program. Look forward to speaking